Chapter 1. Okay, let's start today. Okay, first of all, welcome to accounting. Today we're talking all about accounting business. How's it all work? Where's it all going? Again, what's the importance of accounting? Why do we need it? What's the purpose? Again, accounting serves a major purpose. It's a major building block in business. And the importance of accounting is how it relates to transactions. We have to identify transactions, record them, then communicate. And I'm give an example: the sale by Apple of an iPhone. Okay, that's a business transaction. We input it, keep a chronological log of transactions as they happen. Then we communicate the results, financial statements. Is all right overall? How many did we sell? What are our sales? What are our expenses? Do we have anything left over? Any profit? Yeah, that's what accounting really is. The information, measurement, identifies, records, communicates all the business activities. What's happening in the business? And again, who uses accounting and opportunities? The answer is going to be everyone uses accounting. Accounting is very important even if you're not an accounting major, because the biggest thing, accounting is used to make decisions. That's why it's called the language of business. Okay, and again, the biggest and the most important reason why why we need accounting is because it's used to make decisions. Every decision we make in business, it's made by accounting. Okay. Now again, we have our internal users and external users. Our internal users are people who are within the company, lenders, shareholders. Okay, the managers, people who are in the company, who actually have to use accounting because they have to make everyday decision. Okay, what should we, give an example? What product should we buy? Who should be staffed? Who should not be staffed? Should we open up a new location? Should we shut down one? Actually, use people who are outside the company. They have an interest in the company, but in the meantime, they're not actually part of the company. And again, lenders, if you get a loan, you have to give your financial information. Government wants their taxes. And again, customers too. Now, accounting, a lot of people don't realize that there's a lot of opportunities in accounting. You don't have to be an accountant here. All these different jobs, all these jobs are related to accounting. Again, look at different opportunities here, I need to know here. Yeah, one of the most important things we have to have in accounting is ethics. Yes, everyone has different ethics, but in the meantime, in accounting, we all want to be in the same ethics. Okay, ethics is what we deem to be right and wrong. It's very important here. In accounting, you have to have a strong set of ethics, and for accounting-wise, we're all going to have the same ethics. Okay, again, look at any ethical concerns. What's going on here? Are there any ethical concerns happening here? Look at your options. What's happening with it? And of course, the last part, make a decision here. Now, the one thing we try to avoid in accounting is fraud. Fraud is when you intentionally commit a false act for your own benefit. Okay. And again, for fraud to happen, you have to have three things. Okay, you have to have the opportunity, the pressure, and rationalization. First of all, the opportunity. Can you even commit a fraud? Okay, that's where it all starts with, opportunity. Do you have pressure? Do you have a lot of debt? Do you have any financial pressure? What's happening in your life, personal life here? Okay, then the other thing we look at is, you rationalize. This means after you committed the fraud. Okay, so I did the fraud. It's okay if I did it. That's the way you feel. If you're like, all right, I did the fraud, but you rationalize in your head. It's okay that you committed the fraud. Again, in the early 2000s, there was a lot of fraud going on. Then on World Cup. Except that's why we had to take, the federal government passed an act called the Sarbanes-Oxley Act. This applies to publicly traded companies. These publicly traded companies have to abide by new laws, new regulations here. And all companies have to abide by these laws. And again, you have to have strong internal controls, more transparency, a lot more stricter penalties. And this all boils down to because of all the fraud that happened in the early 2000s with the Enron and WorldCom. Then we saw afterwards, in 2009, the Dodd-Frank Act. And it put an end to the notion too big to fail here. We talk a lot about taxpayer bailouts now, protects them, any abusive financial services. Now, accounting is governed by GAAP. Accounting, to be useful and beneficial, we have to abide by the principles here. And we're going to call them GAAP. That's the generally accepted accounting principles. Called GAAP here. Yeah, the whole point is why we have to have GAAP and principles is you got to make sure, that's how we hold everybody accountable. Is that right? Everybody's held accountable because we follow the same principles. If we all follow the same principles, we can rely on them. And it can be comparable. That's why it's so important to follow the principles. Now, GAP's only for the United States. International, when you go international, we have different principles we have to follow. And again, international standards for, once you hit overseas. And whatever country you're in, you have to follow them. In the United States, we follow GAAP. When you go overseas, you have to follow the international standards. Framework. And again, in accounting, it's okay to make some assumptions here. We'll talk about some principles and a few assumptions. Look at the cost principle. Everything's measured in dollars and cents. Revenue means you recognize revenue, record it when it's earned. Same with expenses. You record expenses in the period that they help produce the revenue, when it's been incurred. In full disclosure, we don't want any surprises, any details, anything that would impact the user's decision. In accounting, it's okay to make assumptions. One's a going concern. It means, unless otherwise stated, we assume the company's going to keep operating. Okay, until we get back to monetary unit, it means we expect everything in dollars and cents. Okay, every transaction, is it $100, $1,000, and so on. In business, any assumption, keep things separately. We don't want to be mixing any personal transactions in there. And time period says we want to divide the life of the company into periods. It's into months, years, quarters. Again, we're going to have three kinds of business here. We're going to have a proprietorship, a partnership, and a corporation. Proprietorship is the most simplest form. You just have one business, we're done. In a partnership, you have two or more people. Corporation, you can have many people, like the Walmart. Again, accounting constraints. Look at different things here. Obviously, you want to make sure the benefit's higher than the cost. Make sure it's not too much here. And again here, look at different principles here, different assumptions. Yeah, the big thing we talked about, the accounting equation, it's always going to be assets equals liabilities plus equity. Remember, after each transaction, you should always be in balance. There's no reason why you cannot be in balance. Remember, after each transaction, you have to be in balance. Okay. Look at different things here. Revenue. Again, look at each transaction here. It says, okay, transaction 1. You invest $30,000 cash to start a account. Remember, every time you do a transaction, you always affect at least two accounts. Can you do more than two accounts? Yes. Each account, you want to either increase them or decrease them. In this case, cash is going up. It's an asset. Equity is going up. Remember, assets, it's all of your resources that you have that brings you economic benefits. Your liability is all your company's debts and obligations. Equity, that's the ownership's claim to the assets. Now, start the business again. So we look at it. So we break it down. Cash, supplies, equipment, that's assets. Liabilities, anytime you see the word payable, like it says, it's a payable. It means you owe. And equity again, that's your claim to the assets. You got some stock in there. You got ownership of the company. You pay $2,500 for supplies here. Again, it affects both assets. But remember, one asset's going down. You use cash to pay for it. Cash is going down. But you bought supplies. Supplies is going up. Again, if you notice what's important thing, after each transaction, the accounting equation is always in balance. Now you bought equipment for $26,000 cash. Again, the account's involved. Cash is going down, except equipment is going up. So again here, we see cash went down, equipment went up here. If you notice, for each for each account, there's a running balance for each one. Next part, you bought supplies on credit. Okay, supplies, assets, $7,100. Again, supplies is going up. So is liabilities because, well, now you owe that money. You owe that. You did the whole buy now, pay later. So again, we see accounts payable went up. So does supplies. Again, as always said, equation still remains in balance. Now, it says here, you provide services to a customer, you got paid immediately, $4,000 cash. The account's involved. Cash is going up. It's an asset. Revenue is equity. Revenue is what the company earns. What does the company earn here? Remember, revenue falls into equity. It increases equity. That's why I went up there. Now it said you had to pay your expenses. Expenses is all the cost of doing business. What do you have to pay just to keep the business going here? You had to pay your rent and salaries to your employees. Again, cash is an asset. It's going down because you had to use cash. Expenses going up, but it's decreasing equity. It says right here, expenses takes away from equity. Your equity is going down. Remember, expenses decrease equity. Now say, provide consultant services, and here you did some jobs on credit. When you do jobs on credit, it's called an accounts receivable. It's an asset because, like I said, you expect to receive funds from that. Again, you actually did the jobs. Again, like I told earlier, you record the revenue when it's earned, and you earned it, so you can actually record the revenue now, even though you have not yet received payment. And that's how we look on the equation. Now it says here, they paid for the services. So now the person who owed you money paid you. First of all, of course, cash is going up. Receivables going down because, well, they paid it off now. The balance for receivables will be going down. So we see. And now it says, those supplies you bought on credit, well, you paid part of it off. Of course, cash is going down now because you had to use cash to pay for it. Your liabilities also went down because, well, the balance now how much you owe also went down. So we see what's our new accounts payable balance from 7,100 now to 6,200. Again, we had to pay our stockholders, shareholders, $200 dividends. So of course, cash is going down because you use cash to pay for it. Equity, though, went up. But remember, total equity decreases because dividends cause equity to go down. It says right here, we see here, $200 of equity going down. The cash also going down because, well, we use cash to pay for it. And again, need to know, again here, remember the most important thing is, you want to keep the chart, keep each balance, plus at the end, assets equals liabilities plus equity. After we do the balance, so we get the balance of each account, we can do our financial statements. We got 4 statements. You want to start with the income statement. Just do revenues minus expenses, okay? It says here, obviously you want your revenues to be higher. That means you earn a profit. In accounting, we're going to call it net income. Then you want to do your statement of retained earnings. What cause changes in your retained earnings? And you have your balance sheet. So show your assets equals liabilities plus equity. Complete financial position. Up until the last one, statement of cash flows, it will show your cash inflows and outflows and the sources of them. And again here, we'll see how they all link together. Start with your income statement. So it says your revenues minus your expenses. And again, it's for a time period. And if you notice, when you did an income, the profit comes down to statement of retained earnings. That will increase my retained earnings, my equity. Up until my balance sheet, I need my retained earnings for my balance sheet. If you notice down here, the balance sheet, assets have to equal liabilities plus equity. And the last part, statement of cash flows. Just remember, it lists all your cash inflows and outflows. And of course, the next part, your sources. What was operating, investing, and financing activities. Again here. In example 1, and how they all relate together. And we see Apple here. Again, keep them in order because one ties into the other one. So we see here, income statement ties to retained earnings. Retained earnings ties into the balance sheet. Ability. Yeah, we can return on your assets here. The ratio form here, again here. Net income here divided by. What's it doing here? And here it measures, is the company getting a return on the assets? Okay. Questions? All right, class. That's all I got for this week. I hope everyone's doing well. Let me know if anyone has any questions, okay? Thank you.